Hey, thanks for jumping on this webinar with me. It's going to be a short, pretty brief webinar here, about 15 minutes or so. And I'm not going to go into any specific details on any single one deal that we've done. But really my goal with this webinar is just to kind of introduce to you who Rust Belt Capital is, how we got started, and our overall investing thesis. Like, what are the investing concepts and ideas that underline and underpin every type of investment that we make. So I'm going to share my screen with you and walk through this presentation and talk about it a little bit more in depth. Now, you should be able to see my screen now. Okay. So Rust Belt Capital. How did we get started? So Rust Belt Capital actually got started back when I was in university quite a few years ago. Now, it didn't get started formally as a company back then, but the groundwork started getting laid for this company. So I was back at Ohio State. I was studying, getting 2 degrees at Ohio State. And I grew up on about 1,000-acre row crop farm here in Northwest Ohio. We raised corn, wheat, soybeans, and cattle. Now, I thought I was going to be in commodity trading because growing up, corn, wheat, soybeans, those are all agricultural commodities. So I went and had different internships and different stuff with different companies that do that, like some of the largest commodity trading firms in the world. Went out and lived in Kansas City and did this. I lived in Chicago and did this. And I would be sitting there on commodity trading desk. And in order for us to make money, we had to continue to trade. And this means we had to continue to buy and sell. And if we weren't trading, we weren't really making money, which introduces more risk because you can only sit there for so long without taking a position and not making money before you feel this pressure that you need to get something done. And so it was about this time that I thought, what if I could make one trade one time and continue to get paid for it? And that way, all I had to do is look for the best trades to make. Well, if you sit there and you think about it, that's actually not trading, that's investing. And so that's where this finance, investments, investment banking part came in. Because investment banking is basically at the analyst level of investment banking, you're doing the due diligence or putting the due diligence work together on these companies. Another way to say that is you're underwriting companies which have more complicated financials. You have your income statement, your cash flow statement, your balance sheet. You're trying to put it all together, understand quantitative and qualitative risk factors, and then figure out what the cash flow of this business is. And once you do that, you can find the value of it because all valuation is figuring out how much cash flow some asset is making, and then you can assign a value to it. This brings in the next part of that. So I started investing on my own. Even before this, I was investing, but I really started investing a lot more. And yes, you can invest in the stock market, but if you start studying some of the best investors of all times, they used other things, another formula. It was not just good assets, it was good assets, leverage, and time. So this is where this idea of private levered investments come in. Now, understanding that businesses can be very complicated, hard to run, and it's a little bit more than just numbers, I wanted to focus on private investments where I could use leverage and they had to be simple. This brings up real estate, okay? Because real estate is generally a simple business. And so at that point, after I proved to myself that I was good at investing and all this type of stuff, I just had to find an opportunity. And so that's where a couple of years ago, our first opportunity came about with what was called Vandalay Commercial Enterprises, 64-unit apartment complex. I found it was for sale and I approached Nate. Now, Nate is somebody that I'd known for quite a while. I knew him, I liked him, I trusted him because I looked up to him as a role model because he had earned that. Operates with incredibly good integrity and a very intelligent man. So I bring it to him. He looks at it, looks under the numbers. He says, this is actually a very good opportunity. Trust me. And we went, and in 3 days, we had everything put together, all the money raised, including which I put hundreds of thousands of my own money into this deal, and he did as well. And so fast forward, the opportunity is going really well. Now, that's how we got started, but who are we? Okay, so more specifically, we're a private equity firm with a specialization in multifamily real estate. Now, it's very important that we say we're a private equity firm or true investment firm first and a real estate firm second. Now, the reason we want to make this distinction is because there's a lot of people out there who are real estate people who maybe don't understand the investment principles that are super important to actually get to the next level, where real estate is just an opportunity vehicle for us. And we're just trying to implement really good principles that are grounded in all types of investing. After that, we have several ongoing successful projects right now that are beating expectations. So we're not just an idea. We didn't just do one deal. We have several. They're all going better than we expected. They're operating as we said, okay, with no surprises to the downside. So I want to say that we actually have actual projects going on right now. This isn't just theory or made up or thinking or anything like this. Okay. Now, what type of asset class do we focus on? We focus on mid-sized multifamily apartment complexes. That's 40 to 100 to 110 units each. The reason we focus on this is because we don't want to compete against Blackstone, who's willing to potentially way overpay on an individual asset because they're managing an entire portfolio that they can blend out wins and losses with. And we don't want to compete against the people who are trying to pick up a 10 or 12 or 20 unit apartment complex, because that's just not where the best time is spent. What we're looking for in a lot of these mid-sized apartment complexes is inefficient operations. Maybe they haven't optimized the asset. Probably they haven't, where we don't have to dump in a huge amount of cash flow, but we bring in intellectual capital, right? We know how to run the asset way better than it's currently being run. So we can step in, rationalize the inefficiencies in there, increase the cash flow on this property, and then hold on to it for a long period of time. It's a big differentiator with us, is that we focus on holding on to these projects for a long period of time. We underwrite the 10 years with the anticipation that we're going to hold on to them at least for 10 years. Now, there are ways, if you invest and you want out before 10 years, that we can get you out. That is a possibility. So I can't go into the details of that in this presentation because we're kind of limited on time, but I do want to say that there are ways that we can get you out beforehand. Now, we don't necessarily want you to jump out after 2 years or something like that. We kind of frown very heavily upon that because we're trying to get a whole team of people behind us or add to the team that we already have that believes in the same investment philosophies. So our entire investing theory comes behind this basic formula, which is good assets, leverage, and time. I've already mentioned this before, but good assets, leverage, and time. Now, why is this the basic formula that we use? We kind of just copied Warren Buffett, more or less. Back in university, as I was studying, you obviously are going to run across Warren Buffett, Berkshire Hathaway. You're going to learn about this company. Otherwise, I'm not sure what you're studying if you're trying to learn how to become an investor. Probably the greatest investor of all time. Now, if you study Berkshire Hathaway and Warren Buffett, he uses this formula. This is not my formula. This is his formula. And if you watch Berkshire Hathaway, what they do is they go find a business. Typically, it's not listed on the stock exchange, so it's not a public company. And then they'll go borrow money to buy this business that generates a lot of cash flow, and they'll hold on to it for a very long period of time. One thing you can go look up is that Berkshire Hathaway bought Geico, Government Employees Insurance Company. They did that so that they could borrow money at basically lower interest rates than all of their competition, so that when they went and bought a business, they could finance it with basically in-house financing that was still borrowed money, still leverage, but made it even better, more advantageous than having to go to the debt markets and trying to do that. So this formula is the exact same formula. This is Warren Buffett's core investing formula, not ours. We use it. We've implemented it on several of our deals. That's what we're trying to do. And our favorite holding time, just as Warren Buffett says, is for as long as freaking possible, right? And we want cash flow. That's a big, important component of what Warren Buffett did is cash flow. Now, why is this formula so important? I'm going to show you an illustration. Here's an illustration just to give an example or a tangible example to the idea of why we want to implement this formula. You have two charts here, two graphs, two pictures. Say you know somebody young. Doesn't have to be you. It could be your kid, your grandkid, could be you. I don't know. Say they're 25 years old and they have $25,000 to invest. Now, if they invest that into something that makes 10% per year, let's say that's the stock market, the S&P 500, and they just leave it there until they retire, that's going to be about $1.1 million. That's one decision. That goes back to the commodity conversation I had. I want to make one good decision and get paid for it handsomely over a long period of time. That's exactly what happens here. It's crazy to see this. Okay. Now, what happens if we can implement this formula and use the good assets? We know how to actually find the good assets, not just do this diversifying, blindly applying diversification. And we can use leverage, which you can't really use if you're invested in the stock market. And then, yes, we give it time following this guy, right? Well, if we can just influence it to go to 15% per year, by the way, this guy over his career did way better than 15%. But say we can influence it to do 15% per year, which is our minimum, okay, that we're targeting. We can't guarantee it, but that's our minimum that we're trying to achieve, net of fees and of all that type of stuff. Over the same time period, that same $25,000 one-time investment goes to $6.7 million. That's a huge difference just by using this formula, right? Now, you could be saying, hey, Steven, I don't have 40 years. Let me ask you this. Can you think of somebody that you love and care about a lot that you could change their life, or you can guarantee that they have better odds of being financially stable in their life by passing on an investment that produces an enormous amount of cash flow to them, and they don't have to be subject matter experts on it? They don't actually have to run the business because you've already hired the experts to maintain and to watch it and to monitor that for them. Probably so. And here's what we're getting after. It's called cash flow stacking. Now, let's say you invested $50,000 a year for 10 years. What would that look like? Okay, let's be real conservative too on the payouts. Here's our payouts, and here's what the payouts are growing at. Here's our payouts is 3% per year. This 3% is going to increase by 2% every year. So here's what it starts to look like. Yeah, first couple of years, not a game changer. But by year 10, you're making $60,000 a year in passive income and dividends. Okay. And your true investment at $50,000 a year out of pocket is not $500,000. It's only $302,000. Now, if I ask you the question, would $1 million be enough to retire on? You're probably going to say, heck no, right? Here's $302,000. So that's only a third of $1 million. It's paying you $60,000 a year. That's the starting salary of somebody coming out of college with a finance degree for a lot of times on average. And guess what? Here's another look at it. This green bar is how much of a pay raise they're getting every year. Here's a $60,000 pay. They got a $10,500 pay raise. How many businesses or how many employees are going to get a $10,000 pay raise by their employer? Oh, and next year, they're going to get another $10,000 pay raise, and it's probably going to be higher. Now, obviously, this is just illustrative purposes. Let's, worry about compliance here a little bit. I don't know about you, but even with the price of where houses are going and the insecurity and the economy and stuff like that, like that's a huge difference to a lot of people. So if there's one thing that you should take away from this presentation on what we're going, what Rust Belt Capital's whole focus is, our destination on all of our investments is we're trying to achieve perpetual income. We're trying to produce perpetuities, not annuities, not a giant pile of cash, perpetuities. And let me tell you one story, and then I'll let you go. I'll tell you how you can contact us and get more information. But let me tell you one story on why this is so important. There's actually a time when I was younger, I was trying to buy my second property, and I'd been doing very well in the stock market. And so I wanted to borrow money from the bank because the bank was willing to loan it at like 3%, right? So I go and I sit down with the bank. And to give you context, I had probably twice as much or more money in cash than what I was asking for the loan. The loan was not insignificant. It was a couple $100,000. Okay. So I had at least a couple $100,000. I had more money than the entire value of the loan. So I had a giant pile of money. But guess what? Since most of my money was coming from capital gains, or most of my earnings was coming from capital gains, they didn't see the cash flow. And so they didn't want to give me the loan. Most banks didn't. Eventually, I figured out how to get the loan. I had to do a lot of twisted manipulation and rely on relationships that I had. But I don't want to be in that position where, okay, I have a giant pile of cash, but it's worthless. That's where the income part is so important. Investment banks, how do they value an asset? Based on its cash flow, which is why when you get to retirement or you get to a point where you want to take some time back, cash flow is super important. It's more important than how much money you have in the bank. So if you like that, if you like kind of our ideas and you want to learn more about it, I couldn't really get into a bunch of details. Connect with us. Here's how you do it. Scan this and it should take you to a page where you can join our email list. Every week we send out an email that talks about this stuff a little bit more in detail. We try to stay light with it. It's nothing super groundbreaking typically, but we're trying to have a conversation and kind of share more about what we think and what we believe, what we see going on in the market with you, as well as when we have investment offerings, we share it in this email. Now, you can also have a one-on-one email with us. Send an email to investor@rustbellcapital.com. You can talk to either Nate or I, and we'll talk to you even more. Now, if you want to have a phone call with us, go to www.rustbellcapital.com. There should be a green button. Click on that. You can schedule a one-on-one call. Be happy to get into the weeds, talk more deals we've done, answer any questions that I can. And yeah. Anyways, I am very grateful that you spent some time with me today. Let me know what you thought, and I look forward to having a conversation with you. Thanks.